How much volatility are you expecting in markets?
Look, markets will sort themselves out. This is always a typical when something terrible happens. So the first couple of days, there's a lot of scrambling. I think the bigger issue here is this is a manifestation of one of the longer-term sort of forces on the supply side of the economy, linked to the fragmentation of geopolitics. And to me, what this means, it's yet another example of why we're likely to enter a much lower growth era where trend growth is going to head down, potential growth is heading down in all major regions, with the possible exception of Japan. And so this means this world of stickier inflation, low growth, and high interest rates is more likely to persist. And what we see here is one, in a sense, at the moment, regional manifestation of this fragmented geopolitical system that we're in, very different from the Great Moderation.
But Philip, so could we see, and this really seemingly almost came out of nowhere in terms of the intensity of the attack, and I don't know why a lot of intelligence agencies weren't prepared for it, but away from that, could we see actually foreign policy and things like this be much more heightened that we're unprepared for?
It's very hard to tell how this could have happened. I'm not an intelligence expert or a security expert. Perhaps the answer lies in, on the one hand, very high-tech defense system and perhaps relatively low-tech approaches to how you evade high-tech defense systems. So I'm sure lots of experts will think about this. I do think it means, generally speaking, this kind of risk premium, in a sense, around geopolitics is much higher than it has been in previous decades. And that, of course, we've known for quite a while in Europe. This, to me, is another manifestation of this and has big implications on the kind of macroeconomic environment we're in, being very different. We call it a new regime, decisively very different from the past.
What did everyone calling for a recession actually get wrong?
I think the recession is less the issue. The reality is we have very subdued growth. If you look at the average measures of GDP growth economic activity in the U.S., you see that the economy has been basically growing at barely around 1% for the last 18 months. We expect that to persist. That will mean we'll have the longest period of very low growth outside of a recession, even if we can avoid a recession. In Europe, we're seeing flatlining activity. So I think the story is less about are we going to go into a recession or not, but much more about the reality that's beginning to sink in, that we have moved to a much lower growth environment than what we've seen in the past.
But do you think interest rates have peaked?
Hard to tell. We're probably close to it at some level. I think the much more important story is that because of all these supply constraints, including geopolitics, but not only, what we're going to see, despite the kind of waning of the pandemic-related distortions that will bring inflation down quickly, I would expect U.S. inflation to be at 2% by mid-next year. But the reality is going to be that, for central banks, this new macro environment will mean they will not be able to cut rates the way they have done in the past. So we're going to see a very different reaction function, lower potential growth, higher rates, higher neutral rates. And so that's going to mean that this classic response to any problem central banks ease aggressively, that is very unlikely to be the play, as it were, in the years to come.